Hello students, Professor Watts here, and today we're going to talk about the international bond market. Now, this is going to be a pretty brief lecture. If you know how bonds work, international bonds work the same way as any bonds. So it's not like we're dealing with a different animal here. We just want to know about some details and features of the international bond market that distinguish it from a country's own domestic bond market. But in case you don't know how bonds work, let's just begin by recapping some bond basics. What is a bond? A bond is just a structured tradable debt instrument or loan, where these elements are typically standardized: the term or maturity of the bond, and entities can issue bonds in pretty much any maturity term they want to, but some standard typical maturities offered are 2, 5, 10, 20, and 30 years. Now, just a side note, as far as U.S. government bonds or treasury securities, as they're sometimes called, terminology on those, the shorter term ones, less than a year, are known as treasury bills. The intermediate term, 2, 5, they also issue 7 and 10-year are called notes, treasury notes, and then the term bond is reserved for the 20 and 30-year issues for those. The principal or face value, or sometimes referred to par value, of the bond is typically $1,000 increments. It could be $10,000 in certain cases. So if a company wants to raise $1 million through a bond issue, they're going to typically issue 1,000 bonds, each of which has a principal or face value of $1,000. The coupon is a kind of antiquated term that refers to the interest payment that the bond offers. Periodic interest payments, typically for domestic bonds in the U.S., government and corporate bonds pay semi-annual interest payments. There are certain international or foreign bonds that only make annual payments. So if a bond makes semi-annual payments, you take the coupon, which is the interest payment, and you basically divide it in two. So if you have a bond with a 10% coupon rate, that's 10% of the principal coupon, that's 10% of $1,000, so that would be $100 per year. If you're dealing with semi-annual payments, that would be $50 usually on July 1st after the first 6 months, and then $50 on December 31st or January 1st of the next year. Okay, so that's how the interest works, and I'll tell you why this is referred to as coupon here momentarily. And that interest rate or coupon rate is usually fixed. In the vast majority of cases, bonds have a fixed rate, but they can also be adjustable. They can reset, and typically when a bond has an adjustable rate, it might offer actually quarterly interest payments, so that interest rate can update more times throughout the year. And here's an example of a bond from Phillips Petroleum Company. This is dated, you'll notice down here, 1973. And it has a maturity due right here of 2001. So that would be what, a 28-year issue. So notice that they don't have to be those standardized terms, 10, 20, 30 years. They typically are. Companies have actually issued 100-year bonds in the U.S. Pretty rare. There's also a thing called a perpetuity, which is just a bond that makes interest payments every year forever. Actually, it looks like this is a 30-year issue now that I'm looking a little bit more closely. It was issued 71. It's due 2001. So this date right here is probably just recognizing a transfer of the title for this physical bond certificate to this particular buyer right here. So this actually was initially a 30-year bond. Paid 7 5/8%. And if we read the fine print here, we would probably see that, yeah, there it is, semi-annually. So it's going to pay that twice a year. So we could calculate the coupon. We could just say what is 0.758 times 1,000, it would be what, 70, it'd be about $76, and that's going to be paid to the registered owner of this bond twice a year. And then at the due date, which is March, it looks like 2001, the registered owner at the time got the $1,000 back as well. Now the registered owner as of 2001, this bond could have changed hands multiple times since then, and that's what I mean by a bond being tradable. Current owner is the person entitled to the interest payments, and the owner at the end of the maturity is the person entitled to the principal. So bonds can be passed around. That's what makes them securities versus just a straight loan with a bank that's usually not negotiable. Now, where does the term coupon bond come from? Well, in old days, and actually up until I believe the early 1980s in the United States, bonds could be issued with coupons, which were literally, coupons are things you clip, so they were things you clipped off at the bottom and you mailed these in every semi-annual period where the interest was due. So you can see these are dated November and May, 93, 94, 95. And you sent those in to the issuer of the bond, and they sent you the coupon. They sent you the check for that period's interest payment. So that's where the term coupon comes from. Now, coupon bonds were actually made illegal in the United States per government regulation because coupon bonds were payable to the bearer, and it could allow anonymity for the owner of the bond and kind of make it easier for people to avoid having the government track those coupon payments and therefore hold them liable for income tax on the interest they receive. So we don't do coupon bonds anymore in the United States, but the term coupon has stuck. So the coupon is the amount of interest that the buyer receives, and then the coupon rate, of course, is the fixed interest rate of the bond. Now, if you've taken any finance classes, you'll know that there's a difference between the yield of the bond and the coupon rate, because the bond's value will go up or down depending on changes in current interest rates, and then revaluing the cash flow stream of the bond using present value equations based on current discount rates. And I'm not going to get into that here, but hopefully you're familiar with that. So there's a difference between the coupon rate and the yield of the bond, but we don't need to get into that right now. Okay, so we have some basic ideas of how bonds work. Hopefully you knew all of that already, and that was just a review. So let's talk about some differences with the international bond market vis-a-vis a country's domestic bond market. So there's two things to look at when we're talking about international bonds: foreign bonds and euro bonds. So a foreign bond is offered by a foreign company to domestic investors in the currency of the nation where the bond purchasers are located. So, for example, let's say Volkswagen issues dollar-denominated bonds in the U.S. to U.S. investors. Those would be known as foreign bonds. Or a U.S. company, let's say General Motors, goes to Canada and issues bonds to Canadian investors denominated in Canadian dollars. Those would be foreign bonds. Euro bonds, and euro bonds are going to be much more common and a very significant part of the international bond scene, is denominated in a particular currency, often US dollars, but it could also be other major global currencies like euro or yen or British pounds, sold to investors in markets other than the country that issued the denominating currency. So, US dollar denominated bond. So, for example, let's say Royal Dutch Shell, which of course would be a Dutch company, the Netherlands, issuing dollar-denominated bonds to investors all throughout Europe. So there's kind of seems like a slight difference there, but it's actually kind of an important difference. The way to remember this is that euro bonds issued in currency that's not the currency of the people buying the bond. A foreign bond is issued in the local currency, in other words. So that's maybe a good way to think about this. This is issued in the local currency, and this is issued in a major foreign currency that's not the local currency. Let's call it a major international currency. Okay, so foreign bonds and euro bonds are going to be two main categories. We'll talk a little bit more about that in a minute, but let's also talk about bearer versus registered bonds. Euro bonds are usually bearer bonds, bonds in which ownership is demonstrated through possession of the bond not registered through some clearinghouse that keeps track of who owns bonds and who the interest is due to. So bearer bonds are attractive to people who want privacy and anonymity. And let's face it, what's one big reason people want that? Well, the income they receive on the bonds isn't traceable for purposes of taxing. So it's kind of like those coupon bonds that I was talking about a few minutes ago. In prior years in the U.S., those were bearer bonds, and you would just send in the coupon to claim the interest. Your ownership wasn't registered, so you could easily avoid the government tracking the coupon payments for tax purposes. Registered bonds, as the name implies, the ownership is registered through a central registry. It's known as a clearinghouse. And when bonds are bought and sold, the bond certificate actually doesn't change hands. They just replace a person's name on that central registry. And those clearinghouses also then are responsible for issuing the periodic interest payments, the coupon payments, and then the principal payment at the end of the bond's maturity. So registration actually makes things a little bit more convenient as long as people are okay with the government knowing about the bonds that they own. Now, let's talk a little bit about the differences in securities regulations with respect to domestic versus foreign bonds. And here, when we talk about securities regulations, of course, we're talking about financial securities, structured financial instruments like stocks, bonds, etc. And remember that what makes a bond a security, a bond is just a loan, but it's highly structured. It's got that $1,000 principal. It's got that set term, 10, 20, 30 years. It's got the set interest payment. There's usually some kind of master contract behind the bond issuance. So it's very easy for companies to issue bonds. Whereas if a company wants to get a loan, so if a company needs to raise $1 million in capital, well, it could go to the bank and say, hey, can we borrow $1 million? And the bank will say, well, sure, but we need to see your financials and we need to underwrite it and check credit and things like that. But if a company just goes and issues bonds, the bonds will be sold to investors out there in the market, in the economy. And if the investors don't have a really high level of trust in the company, well, they'll just offer a higher interest rate until they find kind of the right balance of risk and return. So it's kind of easier for companies to raise a large amount of money through bond issuance rather than loans for several reasons. But that's what makes a bond a security. So the rule we want to note here is that foreign bonds have to meet the securities regulations of the country where they are issued. That means a country that has more stringent regulations might not be as an attractive locale for multinational corporations to issue bonds. And that's hence the rationale for the Eurodollar bond market. If multinational companies want to raise capital in dollars, they might prefer to issue the bonds in Europe rather than the United States because they might not face as strict securities regulations regarding the issuance of those bonds. Yankee bonds, on the other hand, that would be where foreign companies would come to the U.S. to issue bonds denominated in dollars. So that would be foreign companies issuing foreign bonds within the U.S. rather than issuing euro bonds, dollar denominated, within Europe, or really anywhere else in the world. They're just kind of referred to as euro bonds because Europe is the main place where they would be issued. Yankee bonds, dollar denominated foreign bonds that companies issue in the U.S. have to meet the pretty strict requirements of the United States law and regulations from the Securities and Exchange Commission. So foreign borrowers are sometimes apt to go to that euro bond market, as I just explained. What about a global bond? A global bond is just a very large bond issue that the volume of which would be too large to place all of it in one country. So the companies split it up and they sell it to investors all throughout the world. It's going to be denominated in one currency, though, typically dollars, possibly euros, British pounds, one of the 4 or 5 major currencies. They've been around for about 30 years, and these trade worldwide. Most of them, as I mentioned, dollar denominated. If these are issued, part of it's going to be a Yankee bond, the part that goes into the U.S., and then part of it will be a euro dollar bond, the part that sold in the rest of the world. Let's just look at a breakdown of some international bond instruments, and we're looking at 5 different types of bonds here. They can be straight fixed rate, so just normal bonds with one locked-in coupon rate, interest rate. One key difference between international bonds and domestic bonds or foreign bonds is that these usually are annual interest rather than semi-annual. As I was describing earlier, the vast majority of domestic bond issues in the U.S. or foreign bond issues where foreign companies come and issue dollar-denominated bonds in the U.S. are going to be semi-annual interest. But these are usually bearer bonds with annual interest. And the reason for that is it's just easier for a company to pay interest annually with bearer bonds. With registered bonds, they can pay semi-annually pretty easy. Not a huge difference. That does matter a little bit, though, when you're valuing bonds. So if you were a bond trader, you'd want to be aware of that. So when you plug in the data into your present value formula, you get that right. There is a relatively small segment of the bond market that is floating rate notes. And notice that they are going to pay interest more frequently. So there's time for the rate changes to have an impact. Interest rates on floating bonds are typically tied to LIBOR, which we learned about in the last unit, Chapter 11, London Interbank Offered Rate. It's kind of an average of money market interest rate of major banks in the London Eurodollar market. Convertible bonds are bonds that have an option to convert those into equity. So you could end up kind of getting the bond paid off in shares of stock of the company if you like. Most convertible bonds are options. So basically it's like buying a bond and then an option on that company's stock as well, a long-term option on the company's stock. And if you've studied finance much, you'll know that the difference between bond investments, debt investments, and stock or equity investments is that bond investments they have a fixed payoff. They have limited upside. In fact, it's capped at the coupon rate of the bond. Now, the capital value of the bond could go down if market interest rates go up while you're holding the bond. So there is some downside to bonds. And of course, the company could also default. So you could lose part of the investment. The upside potential of a bond is just earning the interest on the bond. So bonds are relatively safe compared to stocks, at least not as volatile, but they don't have that unlimited upside potential. So that one rationale for convertible bonds is that if a company does really well, you want to participate in that upside growth. Well, but you have the safety of a bond in terms of the legal obligation of the company to pay you the interest. But then you can also participate in the upside potential of buying stock at a predetermined price at the end of the bond's term. So that's the rationale there for convertible bonds. And then similar thing with warrants. A warrant is a right to purchase shares of the stock. So the bond here could pay off in shares of the stock, or the bond could offer the holder, the buyer of the bond, the right to buy a certain number of shares from that company at a certain set price. Okay. Dual currency bond pays interest in one currency, and then the principal pays off in another currency. Very special purpose, not very common. Okay, let's wrap up today just by looking at some stats on the size and trends in the global bond market. A very large market. How much international bonds are outstanding? This is in billions, so this would be in 2018 $11 trillion denominated, 9 trillion euro, almost 2 trillion pounds sterling. Okay, and then a few other major currencies. 25 trillion total, and I'll note that that's larger than the current GDP of the United States. So this is a very, very large market, and remember, this is just companies issuing bonds in foreign countries. So if we added this to domestic debt markets that are going to be even larger than this, there's a lot of debt out there. There's a lot of capital flowing to multinational corporations through these bond markets. Here's a little more detailed breakdown in national bonds outstanding by nationality and type. So notice that the biggest issuers of these are going to be financial corporations, banks, financial institutions, at about 17 trillion worth as of 2018. Governments will raise a lot of capital abroad. There's about 2 trillion there. Of course, you might say, well, the U.S. government has over like 24 trillion in debt. Yeah, the vast majority of that is borrowed within the United States. So those would be domestic bonds, not foreign bonds. But here we see governments getting into the action of the international bond market, issuing bonds overseas, and sometimes possibly in another currency. A lot of times, kind of smaller, weaker governments, to get some more buy-in to their bond issues, will issue bonds in US dollars or euros or pounds, because the investors in those bonds know that those currencies will be stable. If a weak government issues bonds in its own currency, the investors are aware that they could basically have that investment eroded by that government inflating away its own currency and paying the bonds off in depreciated money. So that's one of the rationales for government to be involved in international bond issuance. International organizations, and then non-financial corporations. So we're talking about non-financial MNCs right here. And there's quite a bit right there, but the vast majority financial corporations. And that makes sense if you think about what do banks do. They borrow in order to lend or invest. And part of that borrowing, a lot of it's going to be deposits, but part of it's going to be issuing long-term debt, such as bonds. Okay, and we'll finally conclude here by talking about credit ratings. Now, you might be familiar with credit ratings from your other finance classes. International bond credit ratings are going to work exactly the same as domestic. You'll see the same familiar names in terms of rating agencies. Here, the big three in the U.S., Fitch, Moody's, S&P, Standard & Poor's. And they all have services that rate domestic securities and businesses. And they also do credit ratings for international or multinational corporations. Ratings are basically credit scores for companies, just like you have a credit score when you go to borrow money. You go to get a mortgage, or you go to buy a car and get a car loan or get a credit card. They'll run your credit score, and that's based on how much debt do you have, how much income do you have, what's your track record in terms of paying off your bills, and so on. So they basically are looking at the same things when they're rating multinational corporations or governments. The scoring is a little bit different than consumer credit scores. As you might know, consumer credit scores are on a numeric point scale. It basically goes from like 300 to 800. Bond ratings are usually on a letter basis, and they kind of go from A to C, and we'll take a closer look at that here in just a minute. Okay, so there's creditworthiness is going to be the main factor here, but there's also an exchange rate element, because we're talking about borrowing in a currency other than your domestic currency. So if there's exchange rate fluctuations that could reduce the real value of the bond's interest and principal payments, that could manifest itself as bond investors not really getting the full amount they invested back because they got it back in a currency that depreciated. So that could impact these ratings as well. Okay, so here's a page I kind of pulled out of the textbook that talks about ratings. You can pause this and study it a little bit if you want, if you're interested in the nuances. But there's basically investment grade and non-investment grade. So investment grade would be anything triple B and up. And these are viewed as very stable companies that are very unlikely to not be able to meet their obligations. And you can see kind of how the language is kind of nuanced. Extremely strong capacity to meet its obligations, very strong capacity, adequate capacity. Anything below triple B, we see there's this kind of like financial jargon here, significant speculative characteristics. Well, just much higher likelihoods that these companies will get into cash flow trouble where they won't be able to meet their obligations, and then they might have to default, the dreaded D word, default. Okay, so, and you can see there's some nuance here as well. There's some term here is vulnerability, vulnerability to not being profitable or to not being able to generate cash flow. And then if a company does go into default, there's a couple of ratings there, and of course defaulted bonds, those are toxic. Nobody really wants to touch those, so the value is typically going to plummet. And as the value plummets, the yield on those, the theoretical yield, if they were to be able to resume payment, would go through the roof. So sometimes speculators will pick these up thinking, well, maybe the company will get back on its feet. You know, if I can buy a $1,000 bond for $200 each, and it's got, let's say, a 10% coupon, so it's paying $100 a year, well, the yield on that would be 50%, right? $100 divided by the price I picked it up for, $200. So you could get potentially big speculative payoffs here, but you could also lose your shirt entirely. So these are, like I said, toxic, kind of hot potatoes that not a lot of people want to touch. So there's a couple different levels of default, selective default, or just outright default. Usually in a default, investors don't lose all their money, but they're going to lose a significant amount of money. They're not going to receive the yield, the return that they thought they would. So bond rating is, these are the kind of categories you want to be familiar with, whether we're talking about domestic bonds, government bonds, international bonds, etc. Just something you should have an idea about what these letters mean, because you will encounter this quite a bit. If you wind up in finance and in credit markets, you'll be dealing with this kind of thing on a daily basis. But even if you're just an investor, you're not working in multinational corporations, you still want to have some familiarity with the credit rating scheme and what these things mean, and how to interpret this. You'll be reading about these in then Financial News, Wall Street Journal, The Economist, etc. Going forward. So just have some grounding in this rating lingo. Okay, and that is it for today. We've covered some very basic facts about international bonds. And next week we will turn and look at some basic facts about the international stock market. See you then.